talk us through how your attitude to UK assets is developing as we learn more about the UK government's stance on Brexit and just how hard or soft it looks likely to be.
I think the news we've had over the weekend just reinforces our view that UK assets look attractive, but they look attractive only if you are focusing on the parts which don't have much to do with the UK economy.
Which is the chart that Anna dug out this morning. And there you go. If you're domestically long versus internationally long in the dollar, you've got a little bit more to worry about, which is sterling assets for Anna and I and our pension fund are grand. But if you're a dollar investor, you're a bit pooped.
Sure. I mean, we think that the pound is likely to remain weak. There's potentially further downside there. But the main difference, really, as we view it, is that within the UK stock market, 72% of revenues come from outside the UK. So you can invest in UK assets without having UK exposure. And those are the companies we like. The ones, think the healthcare stocks, consumer goods stocks, which have large international businesses and who benefit from a fall in sterling. That's where we think that there's opportunities. You're seeing that in the fact that the equity market is higher because they're large parts of the equity market. The domestic economy, we're pretty worried about. If you look at the comments, it seems like they're focusing on controlling immigration over free access to the single market. In some ways, the fact that the UK economy has been relatively resilient since Brexit is, I think, the worst possible thing that could have happened because it seems to be giving the politicians a false sense of confidence that frankly isn't warranted, that everything's going to be okay if we leave the single market.
The metaphor that was going around in my head yesterday was it's like the economy is driving a car and we now know the speed at which we're going to drive and we now know how we're going to drive this car, but we have no idea where the sat-nav is taking us. We don't really know where the end destination is. I spoke to the CBI yesterday and they said answers need to actually start coming because businesses need to make investment decisions.
Yeah, businesses can't afford to wait until the final minute of the negotiations to make their decision about where they're going to be based. And the truth is, if the rhetoric remains the way it is at the moment around controlling immigration over securing free trade and services, then it's probably only a matter of time before some of these businesses make the decision to start implementing their contingency plans, and that involves moving significant amount of jobs and significant amounts of investment from the UK to Europe, and that has implications for the UK domestic economy.
I find it interesting that you talk about perhaps this level of delusion that we're living under or false sense of security. Maybe that's perhaps a more measured interpretation of what you have just said. But the question comes is the Bank of England has been lambasted thus far in terms of their policy response. My question to you is there's still the capacity for the Bank of England to do more if they're proven correct, that maybe the Bank of England is proven more correct, one in the eye to Jacob Rees-Mogg, but this Bank of England has more capacity to do more relative to their peers, relative to Bank of Japan, relative to the Federal Reserve. Should they, would they? Is that just a matter of time, Mike, before that comes to play?
Firstly, I think the Bank of England's been exactly right to do what it's done, and there's quite a good chance that we will see more stimulus out of the UK. I mean, perhaps not as soon as November, but if the UK economy in 2017 does deteriorate because it becomes clear that we're not going to get a deal on free trade and services, then I would expect further stimulus from the Bank of England. And I think people who are giving the Bank of England a hard time about this are frankly just sort of living in this sort of world where they think things are going to be great, but ignoring the facts that clearly if UK service businesses decide that the UK is no longer going to be the place that they can do business with our largest trading partner, that is going to have a significant negative impact on the UK economy. There's no question about it.
Some people are very focused on the trade question around the UK and suggest that simply the fact that we've appointed Liam Fox as a trade Secretary of State for Trade suggests that we are going to leave not just the EU but maybe even the common markets, and that's going to be the future, that therefore we're going to be looking very much more globally for some of these trade deals. Simon French at Pamela Gordon, though, was saying in the last hour the political tide has changed with regards to big trade deals, and could we find ourselves rubbing up the wrong side of that sort of global trend, which is quite anti-trade right now?
I mean, possibly, but I think the big issue here is that 44% of UK exports go to the EU. You can't just replace that overnight. Now, I don't think that we're going to get a bad deal on goods, because the truth is we buy more stuff from Europe than the other way around. Therefore, that we're likely to do a good deal on goods. But on services, it's in a lot of European countries' interests to try and take some of the financial service businesses from London to Europe.